Hi there, welcome to Kneppy Invest. Fundies do it, LICs do it, and even if you wanted to find the top 10, 20 holdings of a particular ETF, you can find that information. In fact, just yesterday, I went to ComSec website. I wanted to see what the top holdings were in an ETF called Wire, which is a copper mining ETF, and that information was easily found on the ComSec website. Top 10 holdings, only one of the companies or the holdings is a company I've heard of, Glencore. The other companies I'd never heard of. If you want to see the biggest or the holdings or top 10, 20 holdings of Berkshire Hathaway, easily found. So I thought if fundies do it, LICs do it, and this sort of information is easily found for ETFs, why not Kneppy Invest? So in today's video, I'm going to show you my top 20 holdings plus 6 companies that almost made it onto this list. Now I do have a little bit of a criteria, which might seem a little bit weird because the top 20 holdings shouldn't have any criteria or any I don't know what the best word is. It should be easy. It's the top 20 holdings by percentage. But I do have a few investing strategies. And one of my investing strategies is trading. I do like to trade, and I decided to exclude any of my trading positions in the top 20 holdings. So every single company I will show you today are companies I hope to own for the long term. In fact, all the companies I own, I'd say, actually not all, I'd say 90% of the companies I own or that are featured in this particular list, I own in my superannuation. And I usually don't trade any of my holdings in my super. It's only my personal investing account that I trade in. That might change in the future, but many of these holdings I hope to own for the long term. Many of these companies in this particular list I would classify as high quality. And also many of the companies in this list, I have a fairly high conviction that they will grow over the next 5 to 10 years. Okay, so let's get stuck into it. And I'm not sure how I'm going to go through these companies. Maybe I'll just go through it fairly quickly. I will discuss a couple of these companies quickly because there are a couple of small companies, but the majority of companies in this particular list are pretty big. Not massive, but some of these companies are the biggest companies in the world. But there are also a few small companies that you may not have heard of. So let's get stuck into it. Looking at 6 companies that did not quite make it into the top 20 holdings, but I do expect these companies to possibly feature in future editions of this series. And these are the 6 companies that almost made it into this list. And a few of these companies I've held for a while. Some of these companies not so long. I'm trying to think what the most recent purchase was. I have a feeling it was Zero. Maybe that was about a year ago when the share price of Zero fell to maybe $80. Now, a few of these companies I have traded in the past, Audinate and Zero. Now, I don't consider Audinate to be a high quality company just yet, but it has the potential to be one of the highest quality companies on the ASX. It isn't quite there just yet, and you will see a fair bit of volatility in Audinate's share price. Now, just after Audinate listed on the ASX, I did a little bit of research in the company. For those who don't know, this is a provider of professional AV networking technologies, and it has a moat. So this company will be a global company in the future. And I think it's going to grow quite significantly over the next 5 to 10 years. And you could argue it's probably overvalued right now, but the share price has fallen about 33% from over the last month or so from when I'm recording this video, which is 29th of May. And even though the share price has pulled back a fair bit, I have no intentions of selling and taking profits with this company. In fact, I'm more likely to add to my position if the share price keeps on falling to a point where I see some value in that company, just because I'm very bullish on the future of this company over the next 5 to 10 years. So my conviction on this company is quite high. It's just a valuation of the company right now. Aristocrat, in fact, maybe about a month ago, I was very close to adding to my position in this company because the P/E ratio of Aristocrat was below the P/E ratio of Commonwealth Bank and Woolworths, which is absolutely ridiculous. And a few of the companies you won't find in this list of 20 plus these 6 is banks and mature companies that are not going to grow. So you will see a common theme in these list of 26 companies. No banks, no big non-growing companies. And it was just weird that Aristocrat's P ratio was below that of CBA and Woolworths. And that's just weird. Now, you might say ESG reasons, but then I'll bite back and say, well, Gulf Bank and Woolworths are not the most ethically and morally sound businesses either. And to be honest with you, I prefer to own a company that has potential to grow quite well over the next 5 to 10 years. And Aristocrat, when they did produce their results about a week ago from when I recorded this video, nice growth. And the share price has now taken off again. So maybe I missed my opportunity or missed the opportunity to buy some Aristocrat shares a little bit cheaper than they usually are. Pro Medicus. Now, this is a good one. So Pro Medicus, I think, is, well, I won't say it is overvalued, but the P ratio of Pro Medicus is ridiculous right now. And even when I bought it, the P ratio of Pro Medicus was ridiculous. But I bought it at a share price that was significantly lower than it is now. And when I did buy shares in Pro Medicus, it was a small stake because I went, oh my God, these shares in this company are ridiculously overvalued, but it's just a massive growth engine. And I think even the market is aware that this company will continue to grow over the next 5 to 10 years, possibly even longer. But I'll just take a little position right now. And if the share price pulls back, I add to my position. The share price never pulled back. In fact, if I did add to the position in this company, it was a little bit of a dip. Was it around their results? I forget now. There was a bit of a dip in the share price, and the share price rebounded fairly quickly about 3 or 4 months ago. And now it seems like every single day, Pro Medicus gets to a new record share price. Released another announcement in regards to 4 new contracts on the 28th of May. And the share price reached a new all-time high. And I think the P ratio of Pro Medicus might be like 160. I could be mistaken. So let's have a look. Just going to have a quick look. This is by Comsec, so this could be a little bit skewed because Comsec's not the best. Where is it? P ratio 154.77. Market cap $11.9 billion. Yeah, I bought this company when the share price was 40 to 50 or something, and I thought it was expensive there. Anyway, next on the list is Lovisa. So a few retail companies in this list, I think maybe 2, if I remember correctly. Lovisa has the potential to be one of the biggest retail companies on the ASX because of their expansion plans throughout the world. And this has the potential to be one of the best, if not the best, global retail company on the ASX. One of the other reasons I love Lovisa is their margins. Gross profit margins are really high for this type of company. So I love their rollout plan and I just love their business model. And I think this is another company with a relatively high P ratio, not like Pro Medicus, but Lovisa P ratio right now is 44.68. So a little bit off there, but it's just their growth. So even though the same store sales actually fell in the last reporting period, their overall sales actually grew because they are expanding throughout the world. A dividend yield of 2.1%. The other thing you'll notice here, not many of these companies have a high dividend yield. I don't look at dividends when I do invest. In fact, that's the last thing I look at. And if a company that I do own has a dividend, it's just an added bonus. I'm looking for capital growth. I'm looking for companies that have the potential to grow significantly over the next 5, 10, 20 years. And I want to own those companies for the long term. So that's why most of these companies, more than likely, I'll still hold in the next 5 to 10 years, unless they something happens with their business, if there's a structural problem with their business itself. Anyway, next on the list is Fiducian. I'd probably say Fiducian is my longest held company out of this list, and one of my longest hold companies overall. And again, just like Pro Medicus, I bought a few shares in this company quite a few years ago, and this company just keeps on growing. Now, the good things about Fiducian, it's a growth company. It is a growth company, and it has a nice dividend yield as well. And in fact, the dividend yield is about 4% for a company that I think is going to grow quite well and consistently well over the next 5 to 10 years. Only has a market cap of 244 million, which does surprise me. But I think it has the potential to just grind higher over the next 5 to 10 years at a really nice, consistent rate. So Fiducian Financial Services, very comfortable with that holding. Conviction on that company is probably as high as it can get, just because I think this is the sort of company that when you look back in 10 years' time, It's just done really well, and the dividend will just keep on increasing. And this is sort of the possible income company that I'd love to have when I eventually retire, or maybe I could retire next year. Zero is an interesting one. Just like Alternate, I have traded Zero in the past. And just like Alternate, I actually traded Zero just after it listed. In fact, I bought some shares of this company when it was below $10, way back in 2014 or 15. And I had traded it many times. And I won't say I regretted. Last time I sold shares in this company, not last time, yeah, well, actually it was last time. It was probably about 7 or 8 years ago. Share price was about $20 or $30. And I saw the share price take off. I went, why did I sell the shares? And then I saw a pretty big dip in the share price a few years ago. And that was the opportunity, buy the dip situation. So I bought shares then, and I just said to myself, don't sell shares in this company, because this is one of those companies that could hit it big. And they did change their philosophy on how they're running the business. Instead of going for revenue growth, they're now transitioning to becoming profitable. And the last results they did release a few days ago, in fact, was it just a week ago? Maybe less than a week ago. Zero released their results. So I recorded this video on the 29th. They released their results on the 23rd. So just about a week ago. Results were really good, and they are profitable. And this company has the potential to significantly increase their profits over the next 5 to 10 years. And that's why you do have to pay a nice price for this company. I think the market cap is probably 20 billion. Yeah, 20.3 billion. And it's also mentions P/E ratio 103.7, but I think the profit of this company could double a few years in a row, and that P/E ratio of 103 would look fairly low right now. Okay, so those are 6 companies that did not quite make it into the top 20. So let's have a look at the top 20 companies in my portfolio, starting with. So let's start off with companies that came in, that's so Burgundish, that came in between 20th and 17th, starting with Telix. Telix Pharmaceuticals was a company that I didn't really follow all that much. And the company released an announcement maybe over a year ago, and it was just their revenue growth. And the significant revenue growth I saw in the one quarter, and I went, wow, that's amazing, astonishing revenue growth. And they've just continued that astonishing revenue growth over the past year or so since I've held shares in this company. And the trend is beautiful, beautiful uptrend in the company. I'm pretty sure the market cap of this company is fairly not high. It is strong. It is high, the market cap. I'm saying at 5 billion. 5.17 billion. Also mentions the P ratio 122.6. And just like Zero, I think the P ratio, if you do look at it, you can't say it's expensive, because the profit of this company could explode over the next 5 years. They have significantly increased their spending on R&D, but that's the benefits of a company that can significantly increase their revenue. And in my opinion, the most important job of management is capital allocation decisions. So this company is now operating cash flow and free cash flow positive. So management is deciding, what do we do with this cash flow that is coming in through our business? And one of the things they are doing is ramping up their research and development. That's exactly what they should do. I don't think this company should give their shareholders a dividend for many years. But Telix Pharmaceuticals has the potential to become a behemoth on the ASX, one of the biggest cap companies on the ASX, potentially in about 10, maybe 20 years' time. But this company does have a little bit of competition, but they are expanding what they're selling. So there are a one product company right now. And I think over time, they will expand that to have to be selling multiple products. So Telix Pharmaceuticals, it was just one announcement I saw, and that announcement just sort of within minutes made me decide to buy shares in the company. Just one result, one announcement. That's all it can take sometimes. Now, my conviction on Telix Pharmaceuticals isn't that as high as some of these other companies, but at this point in time, just based on the chart, no reason to sell that company right now. Breville was an opportunistic buy. I saw the share price of Breville for a few years ago. I'm just going to have a quick look at the chart. I'm going to look at the 3-year chart. The share price fell a few years ago to definitely below $20. And just based off what I thought about this company, I thought this was a great time to buy shares. I've been following Breville for a long time. I always thought they were a little bit expensive. And even a share price of $26, the P ratio of this company is 33.2. So I think that's okay, that's fair based off the potential future growth of this company. And Breville does have a name. There is name recognition around this brand throughout the world. This is a global company, and Breville is considered to manufacture high quality stuff. Stuff that I don't buy, but it's okay. Just because I don't buy it doesn't mean it won't be popular. For instance, coffee makers. I don't drink coffee, but they are considered to manufacture high quality coffee makers throughout the world. Maybe not Australia, about throughout the world. Breville does have a name attached to it, and that name, Breville, is worth something. RPM Global. This company I've been following for a long, long time. I've always wanted to take a position. Share price had moved into a downtrend, and as the share price kept on falling, I went, ooh, when will I buy some shares in this company? Now, ticker for this company is RUL. That's one thing I've been mentioning. And I'm just going to look at the chart right now. And this was actually a company I wanted to own. And then I saw a really good time to buy some shares. This was actually towards the end of 2023. So this is not a long-term hold for me just now. But the share price was in a downtrend. And then I saw a bit of a breakout towards the end of 2023 when the share price was about $1.60. Share price is now at $2.67. There was a little bit of a dip in the last few weeks. And I thought, this is a buy the dip opportunity, but I just missed it. And the share price has now responded. Now for RPM Global, there is a potential takeover. I won't say risk, potential takeover. This is an enterprise provider of mining software technology. And there is potential that this company will see significant growth over the next 5-10 years, which is a common story among all these companies. But there's also that takeover potential. I would prefer this company not to get taken over because of that potential growth. But RPM Global, sort of an opportunistic buy a few 6 months ago or so, just because the share price had moved into an uptrend. There was a bit of a breakout. So it is very important, in my opinion, to also learn about technical analysis. That can help your decision making, particularly for companies that are in downtrends. You can see a share price starting to get out of that downtrend, sentiment starting to shift, and that's when you hit and make a buy on a company you've been looking at for a long, long time. Now onto Nvidia, or Nvidia. I would say there is potential that Nvidia will move up this list. Now, when I bought some Nvidia shares before they released their quarterly results so they just released them in May, sort of been just before February, I did a lot of research in AI, which companies will benefit, and the first company that popped up was Nvidia. Now, everyone was saying, screaming, Nvidia is way overvalued, and I bought about $700, or something like that, and I just thought, look, Nvidia is expensive, but the growth potential of this company over the next 5 years is massive, particularly when it comes to data centers. And I just implore you, have a look at the last results and have a look at how much they've expanded, how much they've grown over the past year, and particularly in data centers. Now, they don't own data centers, but their profit in the last quarter was $15 billion. It was just shy of $15 billion. So if you just project this company won't grow or won't drop their profit over the next 3 quarters, that means $60 billion of profit over a 1-year period. Now, the market cap overnight has increased because the share price of Nvidia, I believe, rose about 7% on the 28th of May American time. So the market cap of Nvidia is now a little bit more than $2.4 trillion. But just think, $60 billion of profit, $2.4 trillion market cap. That means about a 40p ratio. Now, that's assuming the profit doesn't grow over the next 3 quarters. Now, management's already forecasting that they will grow in the next quarter. And if that profit keeps on growing, there is an argument to say the P ratio of Nvidia is between 30 and 35 if the share price doesn't move all that much from here. For a company that is growing and has the potential to grow significantly over the next 5 years, I don't think that is expensive. But every single time I go to Twitter, open up Twitter, there's another post about how Nvidia is in a bubble, and they're comparing it to 1999, and those comparisons are completely silly. It's different this time. Most of the companies that are going to significantly benefit from AI are, I won't say mature companies, they're the biggest companies in the world. Now, compare that to 1999. Many companies was just putting .com at the end of the name and saying, we are going to make it big. These were not profitable companies. They were loss-making companies, and it's completely different than this time. And so anyone who compares what's happening right now with AI to 1999, I think is losing sight of reality. So that's Nvidia. I'm pretty bullish on that company. Now, I don't think the company will grow like they have in a past year, but I think it still will grow from here. All right, so let's have a look at companies coming in between 16 and 14. Okay, so we have REA Group. Now, this used to be my longest holding. I initially bought shares in REA Group when I first started investing way back in the early 2010s. So I think I bought my first shares 2010 or something, and it was CBA, then PHP, and then REA Group was just after that. I sold CBA and PHP because then I realized, why would I want to own these companies? They don't grow all that much, because I went from becoming sort of a value investor to more of an investor who was looking for capital growth, didn't care about dividends. That happened fairly quickly. And REA Group fit into that like a T. And then I held it for about 10 years. And then I did a video on why, I think it was why I sold REA Group or something like that, why I'm selling REA Group. And this was when the share price was about $180. I'm just going to look at the chart for now of REA Group. And I just thought REA Group was really expensive. And I'm going to have to look at a 3-year chart, because it was a few years ago. Yeah, the share price was about $180 back in late 2021. And I decided to take my profits at REA Group. It was a sad moment because it was my longest holding. It wasn't my largest, but definitely my longest holding. And then the share price fell. It was good timing because that's when interest rates started to rise. Share price went from $180 all the way down to below $100 at one point. And then I went, I think there's some value in this company. The share price got below about 110. Can't remember exactly when I bought. It was around about $100 to $110. And now it's back up to a level where I sold. In fact, the share price right now is above where I sold. And now it's one of my biggest holdings again. And I have no intentions of selling REA Group. I do like their expansion plans overseas, particularly India. I do think that has potential, but they even have potential to grow even in Australia moving forward. So definitely a company that I think is expensive. It's expensive again. So the P ratio of REA Group is 52, but not overly expensive because of the potential of growth in the company. So I'm very happy to own REA Group and continue to own REA Group for quite a while. Apple. Now, Apple I started buying American companies in my super in 2021. Actually, it was late 2022. I think it was a burst purchase I made. And a lot of these purchases of American-based companies or listed companies is an opportunistic. And remember, in 2022, the stock markets fell, and a lot of these companies, like Microsoft, Apple, a few other companies I'll mention in this particular list, the share price had fallen a fair bit, and it was just based on valuation. That was simple. Share price of all these companies were in downtrends when I bought it, and I just saw the value in these companies at that point in time. And so you will see a few American listed companies remaining in this list. Apple, probably I have the least conviction on Apple, much higher conviction on some of these other companies, and it hasn't performed as well. But it's still, because of name recognition and because of potential products in the future, just potential, I think there is an opportunity for Apple to grow significantly over the next decade or so. And there might be products in their pipeline that we just have not heard of just yet. So I'm happy to be a holder of Apple for the long term. In fact, it's Berkshire Hathaway's largest holding, 41%, I believe, they have invested in Apple. And the best time to have bought Apple, in hindsight, was 2016, when the P ratio of that company was like 12, I think. XRF Scientific is not the smallest company in this list. I think the market cap of this company is 180 million. I was a little bit surprised it made it onto this list. But when I looked at the share price growth since I bought, I went, oh, yeah, it's understandable. It's just that I'd never really look at XRF Scientific. Don't really look at the charts for many of these companies. I will look on occasion. And I just like this company. For some reason, I really like this company. So their technology is used to measure the composition and purity of materials, and really good performance growth over the last 5 years. I think the market cap has increased from 18 million to about 180 million. So it's been a 10 bagger. during the last 5 years or so. And if you just look at the revenue per share growth, earnings per share growth is something like 50% per year over the last is it 5 years? I think it's per year over the last 5 years. So nice growth in the company. You might argue there's a little bit of cyclicality because their services are provided to the mining industry, construction, chemicals, and petrochemicals. So there is a possible cyclicality to that, but I'm okay with that because this is more of a long-term holding, hopefully. But if we do see a downturn in mining, I might be induced to sell some of my shares in that company. So let's have a look at those companies coming in between 13 and 11, just missed making it into the top 10. And first of all, we have the smallest company in this list, Visan. In fact, XRF Scientific. I'm just going to have a look. XRF Scientific, I believe, has a market cap of about 180, 189.2, P ratio 21.33. By the way, for XRF Scientific. So, and it's been growing really nice, and a nice little dividend, 2.3%. But again, I don't care about the dividend. Visan, I think, has a market cap about 120. Beautiful chart, by the way. And one of the reasons I bought Visan was I liked the business, I liked the potential, and the chart looked really good. So I thought this is a slam dunk buy. And I'm just going to tell you the markup of this company is 126.7. So this is the smallest company in this list. P ratio 32.98, but I think pretty good potential growth over the next 5-10 years again. If I had to describe this company, I would say a water services providing company. They do have quite a few subsidiaries. So they do hydrogeological drilling, test pumping, reinjection water, and water consulting. Some of their subsidiaries are Pentium Test Pumping. There's another Pentium in there as well, and also Project Engineering. And the chart looks brilliant. JB Hi-Fi. So this is my second retail company. A little bit of story about JB Hi-Fi. So back in 2012, JB Hi-Fi had a share price of like 7 or 8. It was the most shorted company on the ASX. And a lot of people tell you, don't buy the most shorted company on the ASX. There were a lot of fears back then that Amazon was going to destroy the JB Hi-Fi business model. And I didn't care about that. I just thought it was a brilliant company because every single time I either went into a JB Hi-Fi or walked past a JB Hi-Fi, it was full of people. Now compare that to Dick Smith. Remember Dick Smith had some stores back then? Every single time I went past a Dick Smith electronics store, there was no one in it. One time I went in there, I was the only person in a Dick Smith electronics store. And same time, just after that, I went to a JB Hi-Fi. It was full of people. And that's simple reason why I bought some JB Hi-Fi shares and completely skipped buying Dick Smith. Now, then I sold JB Hi-Fi shares when it doubled, so about $16 or $17. And I should have just maintained my holding because the current share price of JB Hi-Fi is, what is it? It's $57.60. So this should have been a long-term hold for me, but I thought I was being very smart, selling my shares when the share price doubled. So I bought shares a few years ago and have been happy ever since. And even now, I think this company has potential for continued growth. It's one of the best run companies in Australia. They get most bang for your buck in terms of store size. And market cap is 2.3 billion, P ratio 15. I would prefer that to be a little bit lower, but that's okay. 15.2 for a company that has potential to grow really nicely over the next 5-10 years. Dividend yield 4.8%. So this is an instance where I think a company can grow and they're giving a really nice dividend yield, 4.8%. I'm going to take that every single year. Now, Novo Nordisk. Another interesting story here. So remember those fears around Ozempic destroying ResMed, and we'll see in ResMed featured later in this particular video. So at the same time, I bought ResMed and Novo Nordisk as sort of like a hedge. It's just a hedge. So I bought ResMed because I thought the market was overreacting in regards to how Ozempic was going to destroy that business. But at the same time, I bought Novo Nordisk thinking, if Ozempic is going to change the world in regards to obesity, that sort of thing, Novo Nordisk is one of the companies I'd want to own. Also own Eli Lilly, by the way, a much smaller portion of Eli Lilly. And it's just happened that Novo Nordisk and ResMed share price have both taken off. So Even though I originally got into Novo Nordisk as a hedge against possibly ResMed being affected by Ozempic, it's actually gone well for me. So a little bit surprised Novo Nordisk didn't make it onto this list, but yeah, happy. And again, I think Novo Nordisk might be the biggest company in Europe. I have a feeling it is now the biggest in terms of market size. Biggest, I'm going to just Google it, biggest European company, biggest European company by market size. No, there it is. Novo Nordisk is the most valuable company in Europe, market cap of 554 billion, followed by LVMH, which I'm assuming is Louis Vuitton, and ASML Holding. Also in Volkswagen. Currently, Volkswagen has a P/E ratio of 4. Yes, Volkswagen has a P/E ratio of 4 and a dividend yield of something like 7 or 8%, which is quite high for a company that's not in Australia. List of largest companies in Europe by revenue. Shell, number 1. Volkswagen, number 2. Uniper, number 3. Total Energies, Glencore, BP, Stella. A lot of oil and gas companies in that list. There's Mercedes-Benz there as well. All right. I'm veering off on a tangent here. So those are companies coming in between 13 and 11. Now let's start looking at my top 10 holdings, starting with companies coming in between 10 and 9, I think. Yes, 10 and 9. So now down to 2 companies per slide. Amazon is on this list, and this is another company, just like Apple, where I bought. Share price had fallen a fair bit a few years ago, and this was the time to buy Amazon. I've always joked that eventually Amazon will run the world. And sometimes whenever I say that joke, sometimes I think there is potential that's going to happen. I too like Amazon, particularly the Amazon Web Services. They're also pretty sure, is it Microsoft doing the data centers? I think it's Microsoft who's really expanding the data centers around the world. So Amazon, that's sort of a no-brainer for me. Even though Jeff Bezos has left the business, I still think it's going to be a behemoth in terms of company size over the next 5 to 10 years. No threat to the Amazon business model. Johns Lyng Group is an interesting one. So Johns Lyng Group listed on the ASX, I'm thinking maybe 8 years ago, 2016, I'm just going to have a look at the chart right now. I'm going to have a look at the 10-year chart because that will tell me exactly when. 2017. I didn't really know or heard of this company until about 2020 when the share price was $2. And I bought just after that. Not a lot of shares in this company at that point in time, but the share price almost quadrupled, almost 5-bagged from when I bought to about 2021, 2022. Share price has really done nothing over the last 3 years. It's gone sideways, drifting down. But funny enough, back in 2021, 2022, the P/E ratio of this company was absurdly high, something like 50 or 60, maybe even 70 at one point. But right now, I look at Johns Lyng Group and I think there's pretty good value in this company. So P/E ratio 26.8, market cap 1.5 billion, dividend yield of 1.8%. But again, that doesn't bother me. And they've expanded into America, and there is potential for significant growth in this company over the next 5 to 10 years. In fact, instead of buying insurance companies, I would never buy insurance companies. I'd rather buy Johns Lyng Group and insurance brokers like AUB or Steadfast. So Johns Lyng Group made it into top 10 simply because of the run in the share price from 2020 to 2022, just a 2-year period when the share price absolutely took off. Now let's have a look at the companies coming in, number 8 and 7. And we'll start off looking at Goodman Group. I have held Goodman Group off and on over the past 5 years. And then as soon as they mentioned data centers, I took a position, bought some more shares, not more. I bought shares in the company and went, not going to sell anymore, not going to trade Goodman Group. This is going to be a long-term holding. And of course, what happened straight away, share price took off from there, all because of data centers. Current share price, 34.26, surprises me. And the chart looks absolutely brilliant, beautiful looking chart. And I'm just glad I took made the decision to buy in. I think it was back in October last year, about October, maybe November last year, I forget exactly when. And the share price has increased by about 60 to 70% since then. I would listen to people who'd say this company is overvalued. It's all based off data center hype. I could understand that. But then again, I would not listen to people who call this company a REIT. This is lumped in with other REITs. It's not a true REIT because they're more of an asset manager. And that's why I like this company as well. A really good asset manager and one of the highest quality companies, in my opinion, on the ASX. So Goodman Group coming in number 8, just because the share price has significantly taken off over the past 8 months. Coming in number 7, we have Neuren Pharmaceuticals. This was initially a trade back in 2021. Was it December 2021? I think it was December 2021. Maybe it was 2022. So let's have a look at the chart again. So this was, share price was $3. Yeah, 2021, December 2021. Share price on one day in 2021 increased 94% up to about $3, $3 or $4. I forget exactly when. And then I just saw that announcement. I went, this is a no-brain buy for the long term. So I bought a trading position in the company, and that was at $3 or $4. Current share price of Neuren Pharmaceuticals is $23.11. I have taken profits. So this would have come in easily number 1 if I didn't take profits, because this is almost a 10-bagger for me. And at this point in time, I have no intentions to selling my holding in this company right now, because I've taken profits along the way. And even though the share price keeps on increasing and my holding keeps on increasing, it's just the potential of this company. There has been a shorting attack against Neuren, but that's not a bad thing. And again, I think because this company is getting a lot of money because of their deal with Acadia, a lot of royalties, their tiered royalties is pretty good as well. A lot of, what do you call it, incentive money, like $200 million. What do they call it? Incentive money. I forget what they call it exactly. But anyway, they've got a lot of money on the books. They're probably expanding their R&D. Nice little pipeline as well. They just released some good phase 2 results in regards to Pitt Hopkins. So at this point in time, very comfortable holding Neuren Pharmaceuticals for the long term. Will I add to my position in this company? Probably not at this point, but the chart looks brilliant. If you do look at the weekly chart, it's a beautiful looking chart for Neuren Pharmaceuticals. A little bit of volatility in there, but again, I'm okay with that. For those who have never heard of this company or don't know anything about this company, market cap is $3 billion. It says PE ratio 24.8, but I wouldn't look at the PE ratio of this company because they did get a lot of one-off payments from Acadia because of those the deal they made with Acadia many years ago. First heard of Neuren Pharmaceuticals well over 10 years ago. Very much a story stock back then, and I went, I'll just see how this company does. It took them about 10 years before they hit pay dirt. So sometimes for these biopharmaceutical companies, it can take a long time for them to hit pay dirt. But what they're doing is beneficial. And that's another reason to like Neuren Pharmaceuticals. What they're doing is very beneficial because they're focusing on diseases that the major pharmaceuticals companies don't care about, like Rett syndrome, Pitt Hopkins, and those sort of diseases, or whatever you want to call them, need help, need something to help people affected with those horrible diseases. Okay, so let's have a look at the companies coming in between 6 and 5. And ResMed is on this list. I've already talked about ResMed in regards to Novo and Nordisk. Share price dipped late 2023. Sort of a really no-brainer to buy a high-quality company at really good value. Current P ratio of ResMed probably is about 30 or back up to 30. I'm just assuming right now. Just going to have a look again. A P ratio of 30, market cap 20.2 billion. One little concern I did have was margins, decreasing margins, but in the last quarter, margins increased. And I think the share price did take off. I have a feeling it did increase on the release of their quarterly results. And the chart looks really good now. And I think, again, the market overreacted. That's one thing I do look for, overreactions from markets. You do see it on occasion when it comes to high-quality companies like ResMed. And I do know a lot of people who hopped on. I just wonder who was selling ResMed when the share price got down to $20, $21. What was the low? What was the low in the share price? Was it $21? It was almost $21 back in September, October last year. I thought it was more like November, December. But yeah, it was just a really overreaction from the market. I didn't buy shares at the low. It was a little bit above the low, but a really no-brainer decision buying some ResMed shares. And I bought quite a few. That's why it's coming in at number 6. Coming in number 5, we have Alphabet. This was a no-brainer as well. So I bought shares when the share price was under stress because we're rising interest rates, and I just saw value. I think there's even value in Alphabet right now. There was maybe a few weeks ago, when the P/E ratio of Alphabet was below the P/E ratio of CBA. That's just stupid. If you had a choice between Alphabet and CBA, there's no decision. There's no decision because Alphabet has their fingers in the AI pie. This could become another behemoth on the this could become another behemoth. It's already behemoth. It could be a massive behemoth, along with another company that you'll see later in this particular list. So, no, 100% conviction with Alphabet. Doesn't mean they'll absolutely kick it out of the park, but they have the potential. That's the main thing. They have potential to become significantly bigger than they are just now because of AI. Don't underestimate the impact of AI on our lives over the next 5, 10, 20 years. It's going to be significant, and the companies that win out are going to be huge. Wouldn't be surprised to see some of these companies broken up because of how big they will eventually be. And Alphabet could be one of those. For those who don't know, Alphabet is Google. They just changed the name. Okay, coming in number 4 and number 3, we have 2 overseas listed companies. First one is Microsoft. Is Microsoft the biggest company in the world right now? I have a feeling it might be, because it's definitely doing better than Apple. And again, Microsoft is the simple one. It was a no-brainer. And this was probably my best trade because this was when share price was falling. And then I saw signs the share price was starting to, or the sentiment was starting to shift from negative to positive. And that's when I bought Microsoft shares. And since then, the share price has, don't think it's doubled. I'm just going to have a quick look. I can tell you exactly when I bought because I do put it, I have it in my trading view. So I bought Microsoft. In, it would have been February 2023. Share price 263.15. Wasn't the bottom. The bottom was about $215, but that's when the share price broke out of its downtrend, and that was a beautiful trade. Share price currently 430, so not quite double, but it won't be far off doubling, I think, soon-ish. And the beautiful uptrend in Microsoft. Pretty sure the share price now, or very close to the all-time high. Yes, very close to the all-time high for Microsoft. So this is another company where I think will become, no, not become, that's the wrong word. It is a behemoth, and it has a potential to grow significantly. Another company with all their fingers in their AI pies. TSMC, so Taiwan Semiconductor Manufacturing Company. This was a valuation play. I saw the P ratio of this company get down to 12, and I went, why is the P ratio of this company 12? It's stupid. It's ridiculous. I don't understand this one at all. And again, I just thought, yeah, this was just a valuation. And I'm having a look at the, oh, what's happening here? I'm just going to have a look at their chart. I'll just tell you when I bought. TSMC. What's the ticker code? I thought it was TSMC. I could be wrong. Taiwan. It's probably a little bit different than that. TSM, yeah. So I bought shares in TSMC in February 2023. So I bought a few companies in late 2022, early 2023 at 92.22. The low in this company was $60. They would love to have bought shares in this company at $60, but I bought shares when this turnaround was pretty obvious, and the share price has increased by 75% since then. And the P ratio right now is 30. So yeah, maybe it wasn't 12. I think it was 12. I'm pretty sure it was like 12. Pretty sure I looked at the P ratio of this company and thought, that's ridiculous. Ridiculous. Anyway, high quality company on the ASX, or not the ASX, on the New York Stock Exchange. It has the potential to grow significantly from here. If it was on the ASX, would this be the biggest company? Yeah, by far. Probably be double the next biggest company. Anyway, let's have a look at the company coming in number 2. So the top 2 companies to go, and that company is Gentrack. This is not a company I think I will own for the long term. However, I have owned shares in this company for the past 3 years. I just implore you, I won't show you right now, I implore you just to have a look at the chart of this company. So I bought shares in Gentrack back in late 2020 at about $1 to $1.50. Forget exactly when. Now, before that, the share price was under really big pressure. In 2018, 2019, share price fell from about $8 all the way down to below $1 during the COVID-19 financial panic. Share price moved into a nice little consolidation zone. I thought there's really good value in this company, even though the market hates the company, even though this is a potential turnaround story. And don't listen to people who say turnarounds seldom turn. There have been a lot of turnaround stories, and there will continue to be a lot of turnaround stories. And I think a lot of people fall victim to the belief that turnarounds don't turn, and so they lose these sort of potentials, setups. Now, I bought Gentrack shares a little bit early, 2020, and share price broke out 2022. I think it was December 2022. So I had shares in this company for about 2.5 years before the breakout. And when the shares in this company broke out in late 2022, it was a beautiful breakout. Share price broke out just above $2. Current share price of this company is $9.18. I was thinking of selling out, so I have taken profits along the way. So again, just like Neuron Pharmaceuticals, if I didn't take profits, this would be by far my biggest holding, by far. But the share price of this company keeps on increasing. So my holding in this company just keeps on increasing because I don't want to take profits just yet. And I was thinking of taking profits about 2 weeks ago. No, not yet. Not yet. Just keep on waiting. And then the company released their results, and the results were spectacular, and the outlook was spectacular, and the share price has broken out again. And that's why share price is now at an all-time high. And the chart looks beautiful chart. This is a beautiful chart. The sort of company you want to be owning for the long term just because of the chart. But at the current time, it's my second biggest holding, which absolutely staggers me. And I have no intentions of selling this company just yet because of their recent results. Okay, so that's coming in number 2. Now, my biggest holding is, drum roll, biggest holding is IPD Group. Now, IPD Group, for those, I probably should mention what this company does. So one of the main reasons I bought shares in this company was the chart. Second reason I bought shares in this company was what they do. So they design, develop, and distribute electrical products and technologies like power distribution, industrial motor controls, and in automation and industrial communication. So they're in the right space. But when I first invested in this company, they released a really good, it was a profit upgrade, and this was just after they IPO'd. So I'm just going to have a look when they IPO'd. So this would have been maybe 3 years ago. So IPD Group, ticker code is not IPD, it's IPG, because IPedimed has a ticker code IPD. I just wish the ASX has a capability for companies to change ticker codes, because it just makes sense. IPD Group should have the ticker code IPD, but it's owned by IPedimed. Anyway, IPD Group listed on the ASX, I want to think 2021, maybe it was like 2022. It was like it was middle 2021. Share price, they listed at about $1. I bought just after that because they did release a really good announcement. I have a rule, don't buy into IPOs until the company releases their first financial results, so 6 months, or the company releases a profit upgrade. That's the only reason I'll buy into a recent listing, because generally listings or IPOs, their share price falls. I think if you did research on it, the majority of share prices of IPOs fell. But if you have a look at the IPD Group's chart, beautiful looking chart, beautiful uptrend. They're in the right space, not overly expensive either. I'd say the P ratio is maybe 20, 23.7. Market cap is 451. Dividend yield of 2.1%. Maybe the only thing you could say against IPD Group right now is just the chart. Share price is going sideways right now. And I just have not wanted to sell shares in this company, even though the valuation or the holding valuation value of my holding in this company means it's now my biggest holding. Am I comfortable with that? Yes. Does that mean this will continue to be my number one holding? Maybe not. I will eventually expect some of these other companies like Microsoft, maybe Alphabet, to eventually become my biggest holdings. I even would consider adding to those positions if we do see the share price fall, if we see a significant correction in the market. With IPD Group, I'm just very comfortable having the amount of shares I do have in this company right now because they're in the right space. And there is potential for this company to grow quite significantly over the next 5 to 10 years. And I want to be a part of that. And again, the only thing I have against this company right now is the chart looks meh. It's not weak, it just looks meh right now. Okay, so that's all I've got for this video. Looking at, no, looking at the top 20 holdings I have, including 6 companies that are not quite in this list at this point in time, but I think those companies have the chance. Now, I do have a few other holdings that I am trading that would have come in quite high on this list, including Integrated Research, released an amazing profit upgrade a few weeks ago, and the valuation of that holding just popped up significantly. Also, a few other trades I'm making that would have fallen high in this list, but I've decided just to exclude those companies because there is a chance I might take profits in Integrated Research and some of these other companies. And I wanted most of these companies to be companies that I'm very comfortable holding for the long term. So, do you have any thoughts about my top 20 holdings? And do you have any complaints? Maybe I should be holding more banks. Maybe I'm not the typical ASX investor or the Australian investor. I don't own 4 of the banks in my top 5 holdings, don't own Woolworths, don't own, or one company you won't see is CSL. CSL is probably the top 30. And at one point in time, a few years ago, CSL was in my top 10. Then I actually sold half of my holdings with the share price of CSL got above about $310. I should have bought CSL shares when they fell to about 230. I was kicking myself after that I didn't buy some more shares because I was trading a portion of CSL. But that's one company that I think eventually will make it into the top 20 list that I did not mention. And that's probably the only company I can think of right now that's not on this list that I think will make it eventually onto this list. Otherwise, Woolworths will never be on here. Telstra would never be on here. Macquarie Bank would never be on here. Yes, I'm not as big a fan of Macquarie Bank than other investors. Definitely won't see CBA, Westpac, ANZ, NAB. What other big companies? You won't see insurance companies here. You won't see mining companies on this list. Mining companies, in my opinion, are not high quality companies because they're cyclical and they're all completely reliant on the underlying commodity they're mining. The only company that I would consider maybe owning for the long term might be BHP, because if you do look at the long-term performance of BHP over the long term, it actually has performed quite well over a long period of time. Otherwise, that's it for this video. Hope you've had a good day. Hope you've had a good week. And don't forget, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.